if you're looking for 1031 information, you're in the right spot. So let's just do kind of the perfunctory stuff. If you have questions, type them in the chat. And Vicky and I will kind of, field those which we feel might be appropriate to interrupt Phil and get an immediate on the spot answer. But if we don't do that, don't panic. We'll save them up till the end, and then we'll give Phil an opportunity to answer all of those questions. So again, just use the chat. And unfortunately, I have a conflict. I'm going to have to bounce out of here in about 20-30 minutes. So I'll hang on for a little bit, and then Vicky will basically, take the questions at the end and close us out. So Phil, looks like your screen's up. We'll turn it over to you.
Thanks, Lance, and good afternoon, everyone. It's good to be with you all. Interesting times. Who would have thought that business and properties are just flying off the shelves? And I just was talking to somebody, and they had a listing up in Altadena, if you know where that is, just north of Pasadena. And it was a little 2-bedroom, 1-bath home, nothing special, not that remodeled. $650,000 sales price, 12 backup offers. It just is what it is. Nobody would have thought. But the good news is we're in real estate, and anything can happen. I understand that Leslie Applegate, blah, 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 whatever her last name is, said that we're in an 18 months period where buyers want to buy, interest rates are incredible, and ultimately people are defaulting on loans, and we don't know where the two will meet, and nobody's really sure. So I say, in the meantime, let's take advantage and get in front of people, because 75 to 80% of what you and I do is meet people, connect with them in some capacity. And today I'd like to talk about how the 1031 exchange can get you there, because investors are pre-focused. They already know what they want, and they're looking for 3 different things that we're going to accent on today. So let's go with it. Ask questions as you have need through the chat room, and I would be delighted to answer all your questions. If you don't know the answer, I'll just make it up. You'll never know the difference, and everybody will be fine. No, I'm just kidding. All right. If you're going to create a relationship, the key is to find out what's important to the other person. There are 3 things that really motivate investors for owning property. Obviously, the first one is monthly income. The more front doors that pay you rent, usually the better off you will be, at least financially. Monthly income is great because over time it goes up. I mean, how many times have we seen this this rent control thing, pop up its head? Phil, you and I have been through this a number of times. And the bottom line is that people talk about that because rents just don't seem to be going down. I mean, they may stagger a little bit, but they tend to go up over time because the value of real estate goes up. And the bottom line is income is very important to an investor. They know they're going to get increases. And the more doors they have that pay them rent, the more often they get paid every month. You want to get paid once a month? You have a condo or single family. You want to get paid once a week? You have 4 front doors. If you want to get paid every day, you have 30 of them. I mean, this just comes down to income, but income is broken into 2 sections, rate of return and cash flow. And I hope we can spend some time with this today, because those are 2 very important items that people don't dissect or look under a microscope very carefully. And I hope that we can talk about that today. Number 2, I want my cake and I want to eat it too. I want that monthly income. I want to see that rent check come in and go up over time. But I also want the asset to go up over time. I want the value to be more in the future than what I paid for it. That's the beauty about investment real estate. You and I both know that investors' number 1 regret is, wish they had bought more. But back then, they thought, oh, how can it go higher? Oh, interest rates. Oh, what's going to happen with the economy? Well, they seem to do that in every cycle. But the bottom line is they look back, they realize they should have bought more. And chances just might be pretty good that that could happen again in the future, a number of times. Appreciation is a huge factor to an investor. Number 3, I need a tax write-off. Why? Because the more I make, the more the government takes. I understand they want to introduce a house, or somebody wants to introduce a wealth tax where they want to start taxing you just by virtue of the fact that you own stuff, whether it be stocks, bonds, mutual funds, property. They're just looking for other ways to tax. And the bottom line is that the more you make, they just don't put you in the same percentage category as other people. They just keep jacking up the percentage so they even get more off the taxable income. And that's the beauty of investment real estate. We get to depreciate. We get to write it off. What does that mean? That means instead of spending between 40 and 50 or 60% in taxes off income that the properties generate, I actually get to write off the improvement of the property based on the value at the time of acquisition. And that reduces the amount of percentage that I will pay on the rent I collect. And that's the bottom line. Rents are great, but the government's very heavy-handed. And the more depreciation you have, the more you could hedge your properties. Next, the three main categories: monthly income, appreciation, tax write-offs. All are equally important to an investor. But the bottom line is that how do I actually get my properties to perform better than what they are to create more of these items? And the answer would be, well, let's take a look. Now, my mouse is a little hyper here today, so we'll kind of play with it. Let's make sure it'll keep, it seems to be doing things I don't want it to do. But let's say each one of us who are within my voice, each own two properties, property A and property B. Same square footage, they're both on the same street, they're in the same condition, they're in the same city, they were both purchased in the same month, let's say. The bottom line is we own them both, they're identical properties, let's say they're single families. And the only difference really is A has been paid off in brown. There's no more mortgage on that, whether you paid cash or whether you just paid it off over time. B is leverage, it's got debt on it. So the question is to an investor, how do I create more income? Well, the answer is, which is better? Well, number one is cash flow. Which one will cash flow better? The one with no loan or the other one, the one with the mortgage? The answer is, well, the one that's paid off. Why? There's no debt to service. That is true. However, based on the amount of skin and equity I have in these properties, which property, based on, and you know they're going to earn the same amount of rent. Rent is not predicated upon how much equity I have in a building. So the question is, which property will give me a higher rate of return based on the amount of equity I have in it? And the answer is almost every single time it'll be property B. Why? I don't have as much invested and I can still earn the same amount of rent as A. The equity is not working as hard in A as it is in B. So what does A need to do? Well, it needs to do what? To re-leverage in red on the bottom. It needs to take out some equity or sell it to buy more doors that will also appreciate, that will also produce rent. And the harder it works to produce more rent for me, the better off I am. Number two, which is better of appreciation? Which one's going to appreciate faster? The answer is, you know as well as I do, it's going to be the same. They're identical properties on the same street. So the bottom line is that appreciation does not look at how much equity you have in a building. Appreciation looks at what the property is and where it's located. And these are identical properties. So they're going to appreciate the same way. But I'm getting a better bang for my buck on B because I don't have as much skin in the game, and yet I can still ride the wave of appreciation just as well as my paid off property. Number three, which one will give me higher tax write-offs as far as depreciation is concerned? The answer is it's going to be the same. They're the same square footage in the same street. Nothing's different. It will depreciate the same way, except B has a wonderful interest write-off. Now, some people say, well, Phil, you know, they changed the rules with the Tax Relief Act. They now limit it to $750,000. You can't write off interest above that. Well, you know what? Guess what? That doesn't apply to your rental properties. Your rental properties are exempt from that. That only applies to your personal residence, your vacation home, your second home, not your rentals. B can be totally written off in terms of what? Interest. And that's an important factor. That even makes the rate of return higher on B than it does on A. So the bottom line is, even when it comes to property taxes, they're going to be the same. They were bought at the same time. You say, well, Phil, Congress limited that I can't take more than $10,000 a year in property tax deductions. Not true again. That only applies to your principal residence and a second home or a vacation home, not your rental or investment or business use properties. Those are a complete write-off on property taxes. B is a better deal for the investor. Why? It's re-leveraged so more can grow with a lesser amount of equity. Am I saying that we should re-leverage very high? The answer is no. Every client has their how can I say, their I can't think of the word, their comfort factor in terms of how much they want to leverage. Some don't mind leveraging 40, 50% or more. Others say, only 25% is okay with me. But the whole point is, as you develop your relationship with your client base who owns multiple properties, which your title company can give you the name of these people, the addresses of these properties, how many they own, or you could even seek out with your title company people who own multiple properties so they can search by names to find all these investors who have all these properties for you. These are the types of discussions that will be that you can discuss with your client that will continue to generate more and more talk, which will generate more of a relationship, which ultimately can generate to new listings. So having said that, what if I decide to sell the property? Well, the answer is, there we go again. And the answer is, if I decide to sell the property, the government will charge me a capital gain. It doesn't matter. Anytime I sell anything, whether it's a stock or a bond or a mutual fund or property, whether it's my principal residence, second home, vacation home, or rental, they want their part, because the more I make, the more they take. So how much do they want? Well, they're going to predicate it on the sales price. And they're going to subtract from the sales price what the government calls is your adjusted basis. Very simply put, the adjusted basis is what you paid for the property, plus any capital improvement, minus depreciation, plus closing costs. This adjusted basis that began at $300,000 because that's what I paid for the property, let's say is at $400,000 because I put capital improvements with closing costs minus depreciation. That means $1 million of sales price minus an adjusted basis in this example of 400 leaves me a total capital gain of $600,000. You know what that means? That means they don't tax me based on equity, but only on the capital gain. So if I refinance the property and take all the equity out, this is still my gain. And the government expects their portion of that in terms of a tax. Now the question is how much? Well, before I tell you how much, I just want you to remember, this is tax and legal advice. Unless you're licensed to give this, you're not supposed to do it. But I want to give you a flavor of what it looks like to an investor with a capital gain. Oh, by the way, if this was the sale of my principal residence, the same factor goes in except depreciation. Depreciation is not an issue. It's not depreciable, my principal residence. But they still look at the sales price minus the purchase price plus capital improvements plus the closing cost equals the capital gain. So if this was my principal residence, since I'm married, filing a joint return, the property's in our trust, which means my wife and I own the property, and we've lived in it for 31 and a half years now. They say 2 out of 5. They will take off $500,000 off that $600,000 gain. You know what that means? That means I have to pay taxes on $100,000 when we sell our home in this example. If I was single, I would only get up to $250,000 off that $600,000 capital gain. That means the balance of it, I would have to pay in capital gains tax. If it was a second home or vacation home, same thing applies. There's no depreciation, but except I don't get the $500,000 exclusion, nor am I eligible for the $250,000 because it's not my principal residence. Now let's go back to investment property or any of these properties really. What are the tax rates? What exactly does the government want? Well, number one, on that $600,000 gain, up to 20% goes to the IRS. That's the long-term capital gain. So many people are in the 15%, but this is as high as 20%. Number two, the Medicare, the Affordable Care Act, Obamacare, whatever you want to call it. The bottom line is when that was passed, they levied in a tax on all real estate and stock sales, which means after $200,000 of gain, if you're single, or after $250,000 of gain, if you're married, filing a joint return, then you pay an additional 3.8% into the Medicare or healthcare program. Number three, does that apply to your principal residence? Yes, it does. Does it apply to your second home and vacation home? Yes, it does. And definitely to your rental properties. Number three, the state wants between 9 and 13.3%, depending on your tax bracket. Of what? Of the $600,000 of gain. And then number four, if it's a rental property, the government or your CPA goes back and looks at all the allowable depreciation the federal government allowed you to take, whether you took it or not. But if it was allowable for you to take, then the government says, well, we gave you depreciation, which is a wonderful thing, but we're going to tax you 25% of that. So if it was allowable at $200,000 of write-offs of depreciation, the government says you now owe us $50,000 plus all of number one, all of number two, and all of number three. That's what happens when you sell property. So what's a tax deferred exchange? What is code section 1031, which by the way has been around since 1921? Well, the government says it's a real estate transaction. All it is a sale and a purchase. So if you can help an investor sell and help them buy, the government says we will defer your capital gains. It's not excluded like a principal residence exclusion. It's deferred. What does that mean? That means it's still there. But to sell and buy, you don't have to pay the tax. You can keep that into the acquisition of your new property for the deferral of capital gains tax. Now this is a really important point, and I hope everybody gets this. This purpose of the exchange is not just to not pay capital gains tax when you sell. It's bigger than that. It's for the purpose to allow the investor to acquire better income producing properties that will also appreciate and to grow tax write-offs. This is why we have the 1031 exchange. Simply put, it's to make more money. It's to move your properties around. It's to get rid of your dog properties and go into better properties. Or the properties that are a little too unleveraged, that are very equity heavy, to have them go into other properties that will cash flow and or give me a better rate of return. That's the purpose of the 1031 tax deferred exchange. Will I eventually pay the taxes? The answer is yes, if you sell without exchanging. You can continue to exchange over your lifetime. There's no limit. But the bottom line is that if I have my property in a trust, or if my rentals are in, let's say, LLCs, and I pass, and it goes to my surviving spouse and my heirs or children, the government says they have the CPA reassess your basis. Remember that basis, what I paid for the property? It gets reassessed to the value the day I died. So if I began with a $300,000 property, when I died, my assets are $5 million. Everything's reassessed to the fair market value. So if my surviving spouse and or my children sell the property, they pay nothing in capital gains taxes. Now, I've got to tell you this, and there's no political motivation to this, but I think you should know this. Currently, for our presidential race, have a candidate who has said that they are going to get rid of the stepped up basis if he becomes elected. also said, and they just put out, and that's, I sent out a memo yesterday to a number of people that came from the Federation of Exchange Accommodators, that if this person gets elected, they want to eliminate the 1031 exchange. Folks, this exchange and this stepped up basis is an incredible vehicle to have real estate move. The more real estate is bought and sold, it provides jobs to real estate people, to escrow people, to the title insurance companies, to mortgage companies, inspection companies. The list goes on and on. Accommodators. And the bottom line is, the more money people make off of work, the more they pay in taxes, the more they go out and spend. And that's the word that we herald a few years ago when they were talking with the Tax Relief Act to possibly get rid of the exchange. I'm one of the ones who personally went to Capitol Hill and met with congressional leaders in Congress to explain why they need to keep the exchange. Well, they agreed to do that. But now, you know, we don't know what's going to happen in the future. And of course, if this does happen in the election, I mean, you know, CAR, NAR, the Exchange of Federation Accommodators, all of us are going to be petitioning and lobbying very heavily. But the bottom line is, this is the future of real estate. This is how people make money. And this is how people make their living. And it's been a really good thing so far. All right. No political agenda in that, by the way. So I just like, you just should know this.
I have a quick question for you, a couple. Can I sell an income property in Texas and buy in California?
Absolutely. You can acquire anywhere in the United States that you like. And I'm going to have a slide for that that's going to go over what you can actually acquire through the 1031 exchange. Because it does says it has to be a like-kind property, but I want to expand on what that means. Good question.
We had one other comment or concern with the COVID restrictions for landlords late. How do we counteract that perception? So,
if I had the answer to that, I wouldn't be in front of you right now. Look,
got the answer.
Here's the answer. This is the best answer I can come up with. This too shall pass. I know it's difficult. I know that there are mayors and governors out there who have encouraged people who claim they've been affected by it, that they don't have to make their payments. I do know also that many lenders are working out forbearance agreements with landlords. I know we got a call on one of our rentals recently that we have a loan on, and they wanted to see if we need to continue or create a forbearance agreement because we weren't getting paid by the tenant. So many of the lenders are working with them, but the problem is, you and I both know with the forbearance agreement, that money doesn't go away. It's just put on the back end of the loan, and probably I'm gonna have to pay interest on that. But the bottom line is that not all, but many lenders are working and understanding that, look, you can't get blood out of a turnip. If these tenants are not paying their rent, it's obviously no fault of your own, and they will do their best to work with you. That's the best answer I can come up with. Anything else? Nope. Okay. So how do you take a listing and you're going to sell a piece of investment property. So the question is, based on your knowledge that there is an investor or a tenant in the property, what should you ask them? The answer is, why are you selling the property? And what do you plan on doing with the proceeds of the sale? Why? Number one, many people sell, I get calls twice a week. When people want to set up an exchange, I don't set up 2 a week. I just get this kind of call twice a week where they say, I need to set up an exchange. I just found out I have to pay a mammoth amount of taxes. And the answer is, sure, give me the name of your escrow officer. I'll call up escrow, get it all set up. You'll be good to go. And the answer is, escrow closed yesterday, or it closed a week ago, and no one ever told me. Well, folks, I know that your RPA has multiple places that you can't give tax advice. They need to go seek out tax counsel to find out if there's a tax ramification for the purchase of the sale of this property, blah, blah, blah. CAR has it in multiple places in your RPA. But people don't read that or they don't exercise it. So when you take the listing and you find out there's an investor, best question is, did you know that you may have a capital gain and the government will allow you to defer the capital gain if you execute something called a 1031 tax deferred exchange? Why don't you find out from your CPA if you're eligible for it? That's the first thing. The second thing is when you ask, why are you selling the property? What do you plan on doing with the funds? You want to represent them not only on the listing portion of this relinquished property sale of this rental to re-leverage into better property, but you want to help them buy the replacement property. It increases your odds of what? Creating more business for yourself. But to do this, the client has to hire an accommodator. The government calls us a qualified intermediary. Other names that are called are facilitator, straw person. There's a million names. Some of them I can't repeat in front of the ladies here, but I'm just kidding. But the bottom line is that you have to have language in your contract that brings the accommodator in. How do you do that? Well, many agents will type in their private remarks when they take the listing that the seller is going to do an exchange, the buyer is going to cooperate, there's no cost to the buyer, blah, blah, blah. And that's good, but it's not the sales contract. It's got to be in the contract. And some agents will write that same language in that we just mentioned that they put in their private remarks. But I recommend that you use CAR zip form. And the name of that zip form is the seller's intent to exchange. That's the only way you're going to find it. They don't have it under Set 1031. It's called the seller's intent to exchange. And what's a beautiful thing about that zip form is that if you need to, you can put contingency language that says that in the event that you go, let's say for example, a 60-day escrow, you can request and negotiate an additional 30-day extension in the event that your client is not in escrow on an acquisition. That's a great thing when there's not a lot of inventory out there and it's tough to find a property in 45 days. So you should really do your best to be in escrow on an acquisition before you could even close a sale. And you can negotiate that on that zip form. But that allows the accommodator to work with the escrow company on behalf of the seller to set up the seller's exchange. Remember, if you look at the bottom, the exchange, we have to set it up before escrow closes. After escrow closes, you can just play that Carole King tune. You know, it's too late, baby. I mean, it just is too late. So the bottom line, we've got to take care of it. Now, the government says that only certain properties are eligible for the exchange. So I want to make this really clear. There's only 3. It says real property held. Does that say residential investment property? Does that say commercial or industrial investment property? It does not. It just says real estate, real investment property that's held for, number 1, income. If it produces income, it's investment property. Number 2, by the way, that income has to be declared on your tax return on your Schedule E, and it's going to be depreciated as well. Remember we talked about that a second ago? Number 2, if it's not there for income, you own the building for your business and you practice your business. Doesn't matter. It's commercial, residential, industrial, office space. It doesn't matter as long as it's being used for your business. Number 3, vacant land. Vacant land can be held for investment purposes because many people have acquired property and they've watched it go up over the years. Biggest regret they have is, you know the answer to that. So what's not eligible? Your principal residence, never eligible. People call me up and they say, Phil, I only get the $500 exclusion, but I have $1.5 million in terms of gain. Can I exchange the balance? The answer is no, it's your principal residence. But what if I own a 4-plex and I live in one of the units, but I rent out the other 3? Then the government will allow us to set up the exchange for the value of the 3 units, that proportion, that ratio, as a 1031 exchange. The portion that you live in, that's the portion that you can utilize the 121 principal residence exclusion for that part of the game. But a principal residence is never allowable in an exchange. Number two, a second home, not allowable. A vacation home, not allowable. A business, not allowable. You can exchange the property the business is in, but not the business opportunity itself. Escrow calls that a bulk sale. They're not allowable in a 1031 exchange. Not the equipment, not the goodwill, nothing, but just the property. What
So
about
Phil,
flipping? Go ahead.
I have a few more questions that have come
Please.
up if you're ready. The market's really tough right now to get an offer accepted based on the contingency to sell. Can you list and sell a property first and then find the replacement property for a 1031?
Yes, I'm going to cover that in about 2 more slides.
Okay, great. Then the other one is, how does the split work on the owner-occupied duplex, for example? I think you just kind of went over that.
Yeah, really quickly, what you do is you have your client speak with their CPA and find out how they've been putting it, documenting it under their scheduling of their tax return. So it could be 50-50, it could be 25-75, whatever the ratios are. Whatever, we want to stay consistent in the exchange based on what the CPA's been declaring on the tax returns. So we just asked them, let us know what the CPA says, and then we will set up the exchange for that amount.
Okay. When you wrap it up, can you show us the slide with the cap gain rates again when you're done? Just slide back that so one of our agents can take a picture.
Yeah, you want me to do that right now?
Whatever's good for you.
Yeah, let's do it. It's right here. I assume they have it yet. All right. If we need it, I could always, if you would like this, send me an email and I'll send you the whole PDF of the PowerPoint.
Okay, we'll have you put your email in the.
Yeah, I have that at the end.
Great.
I'm all set up for that.
All right.
So remember the definition of like kind, and here comes the question you asked earlier. It is not the sale of residential into the purchase of residential. It's not commercial to commercial. It's investment property, real estate, into investment real estate, which means I can exchange a warehouse for a single family rental, investment property only. I can't buy it with the intent to move in, but I have another slide for that. It has to, and it could be anywhere in the country. Anywhere you want to go to, it's got to be US to US, domestic for domestic. Technically, you could also do an exchange of foreign to foreign. You cannot mix the two in a 1031 tax deferred exchange. There's a simultaneous close. When we close concurrently, most people do not do that. Most people close on a delayed basis. That means you have 180 days beginning the day of closing. Let's see, today, according to my calendar, is July 22nd. That means if I close my sale today and my accommodator is all set up, the bottom line is I have 180 days to close escrow from today. Today starts the timer. The egg timer starts ticking, or the sands start falling. But the bottom line is day one is tomorrow, even though I close today. Even if I close on a Friday, Saturday is day one. It's 180 days to close. It's not 6 months. 6 months is actually about 3 days longer. So the bottom line is, if I'm going to do an exchange in the 180th day, I'm gonna cut it real thin. I'm gonna close on the 180th day. I could do that. But if it lands on a weekend or a holiday, I do not get to the next business day. It's that day or before, never after, ever. Number two, I have the first 45 days of the 180 days to identify replacement property. The government does not say you have to be in escrow on a property within 45 days after the sale closes. And by the way, it's the first 45 of the 180-day period. It just says you have to submit a list of 3 qualified properties to you that are going to be investment properties that you want to acquire. You don't have to buy them all. They don't tell you when to open escrow. You just need to acquire at least one of them, if not multiple of them, because the goal is to buy for roughly equal or more. And we'll talk about that in just a minute. What about the COVID-19 extensions? All gone. They're in the past. They're in the rearview mirror. They're all finished. They finished last week, actually. There are no more COVID extensions unless the IRS comes up with something new. And if they do, I'll be the first one to tell you. So the bottom line is that there are no more extensions to the 45 days nor the 180 days. Now, under the 3 property rule, you can name up to 3 property. There are other ways that you can do more, but that's more for agricultural land. If you're going into other states, you want to buy lots of small properties. For you to buy equal or greater, you have to have more than 3 properties to buy. The government provides help for that, but we don't need to talk about that today. Here's the one that you were talking about earlier. The government allows you to do something called a reverse exchange. What's a reverse exchange? The government doesn't care, and I hope you remember this. This is very important. They do not look at when you open escrow on your sale or your purchase. The exchange has nothing to do with opening of escrow. It's the close of escrow. So if you close concurrently, that's a simultaneous exchange. If you close the sale first with 180 days to close the acquisition with the 45-day window to identify, they don't care if you open the purchase escrow first. So the reverse exchange is specifically for investors who want to close a purchase first. Why would they want to do that? Well, they have to have upfront cash and or financing because they don't have the proceeds of the sale because they're going to close the purchase first, right? So they're going to have to monetarily come up with provision to acquire first. And they have to do this with the accommodator because the accommodator is required to take title to the property they're selling the day before they close the purchase. They have to relinquish the title, the ownership. So consequently, our responsibility is to set up a holding corporation that will take title to the Long Beach property they're selling before they buy, the day before they buy the Manhattan Beach property they're acquiring. So the bottom line is you can't have title to both at the same time. And from the time that we take title to the property that they're selling the day before they close the purchase, that starts the timer. They have 180 days to close escrow on the sale. When they open escrow, it's up to them. They have 180 days to close. This allows you to close through a 1031 tax deferred exchange, an acquisition first, and a sale later. How much later? Up to 180 days. That makes sense? Now, I'm sure there's probably a question or two on this reverse exchange. These reverse exchanges are very prevalent. They're a hot commodity in markets that we're in right now, where there's a lot more buyers than there are properties. And some investors do not want to sell because they're afraid they can't find by the time they close a sale, and then with a 45-day identification period, they can't find the right property. Because isn't the purpose of this exchange to create more doors, to create more cash flow, more rate of return, better appreciation, possibly even additional tax write-offs? So the bottom line is, why would they want to gamble? This reverse exchange helps them. It costs a lot more to do this because they have to float money, and our fees go up exponentially. Our industry's fee goes up exponentially because of setting up a holding corporation. Paperwork increases by tenfold. Then we have to dissolve the corporation, or we do a tax return on the corporation. All that costs money. But would a client be willing to spend an additional $6,000 or $7,000 more on the property to do a reverse exchange, to pay the accommodator what the feds require to get the right property? The answer is, in the schemes of hundreds or millions, hundreds of thousands or millions of dollars, we have found that most investors would prefer to do it this way because they find that they don't have to panic and they can just pay a little bit more to get ultimately the package, the big prize of the right property. All right, no questions, I guess. So we'll just keep moving on with this.
We do have one more.
Go ahead.
Does it have to be a long-term rental, or could it be a short-term rental? Would they qualify like an Airbnb?
Airbnb qualifies, long-term qualifies. Remember, what does the code say? To hold for investment, which means rent, unless it's vacant land, or productive use in a trade or business. They don't tell you how to rent it. We all know that there are seasonal rentals, sometimes in the desert or in the mountains. There are times where, say, Airbnb, where it can be vacant part of the time and it could be occupied some of the others. The government doesn't judge it based on that. They judge it based on the intent and your ability to try to keep it rented out. And it doesn't say you have to rent it 30 days out of the year or 60 days or 90 days. It doesn't say anything like that.
So
Can I use it for person? Oh, go ahead.
Can it be for their vacation home?
I was just going to say that. Can I use it for personal use? The answer is yes, but it's limited. The government says that you can utilize it for personal use for 14 days a year, or if you've rented it out more than 140 days a year, then they'll give you 10% of the total amount of days it was rented. So if I rent it out for 200 days a year, shy of 360, the government will give me 20 personal days. If I rent it out for 140 days a year, then I get 14 days. I always get 14 days, but anything above that can't exceed more than 10% of the time it's rented. That I believe, and you should check with your CPA, that does not include times that you have to move in to fix and do repairs and whatnot. That's just basically rental time. I mean, personal time, vacation time. So check with your CPAs about that, but I'm pretty sure that's the way it is. Any other questions on this?
We're good for now.
I'm going to pass on build to suit today. We'll pass on hybrid. We'll come back another time and we can do some of these. This is a very important slide. All the cash from the sale has to go into the acquisition. Any cash you keep is taxable. You can pay from the proceeds of the sale only non-recurring closing costs. What is that? A non-recurring, in black, closing cost is a one-time cost to sell. Many of you already know what this is. It's commissions, escrow, title insurance, transfer taxes, recording fees, or any contractual condition that the buyer has requested that the seller has agreed to pay for. So if the buyer asks you for a credit or to fix blah, blah, blah on the property, and you concede to that and you agree to it, it becomes a contractual condition of sale. Even though it's maintenance, it is a one-time cost to sell because it's a contractual obligation on your part. But if you try to repair those things before you list the property and then to sell, that's considered as maintenance. That's recurring, not allowable. So really, only non-recurring closing costs could come out of the proceeds of the sale. Now, if I can find my little arrow, oh, there it is. I'm going to go back. That's number one. All the cash from the sale has to go into the acquisition minus non-recurring closing costs. But what if I have a loan? I've got to pay off debt on the property, a first, a second, a line of credit, whatever. Then the federal government says that's okay. You can pay off debt when you close your sale, but you can't walk away from that amount of debt. That debt has to be reborrowed in its entirety based on the payoff at the close of the sale when you acquire the new property. Both have to happen. Any cash that you don't replace, you pay taxes, which I showed you on the other sheet, on that amount. That's called cash boot. Any debt that you don't replace, that's considered as debt relief boot. Let me show you an example of what that means. I sell for $1 million, 7% closing costs, $70,000. That leaves me $930,000. Now the question is, how much do I have to buy my new property for? $1 million? $1,001,001? The answer is no. You'll be okay if you do that, but the minimum is $930,000. Why? Because the government wants you to replace all the cash minus non-recurring closing costs and to reborrow the debt onto the acquisition of the replacement property. And if you're acquiring multiple properties, they don't care how you translate that in terms of loan to value for each property. As long as all the replacement properties include the cash from the sale and the cumulative reborrowing of debt, it's a good exchange. So at the close of the sale, we hold the funds. If you're paying off debt, like number 4, $400,000, first, second line of credit, whatever, just don't borrow a year before you sell or refinance before you sell. No, you can do it before a year, but usually not after. The government doesn't want you to sell with the intent to pull money out, or pull money out basically with the intent to sell. That's probably a better way of putting it. So you translate cash, you translate debt, you buy for $930 or greater. You don't put any money in your pocket. That's a good 1031 exchange. Next, how can I replace the loan? Well, you can get a new mortgage for $400,000 or greater. Government's okay if you go up. They just don't want you to go down. Now get this. A lot of people don't know this. The government will allow you to bring in new cash into the acquisition. So if you have $400,000 in your wallet and you want to put that into escrow on the purchase of the new property, as opposed to not taking out a mortgage, it's okay. New cash acts as debt replacement, not from the proceeds of the sale, but from your own personal accounts, however you get it. Or if you put in $300,000 of new cash to replace $400,000 of loan, you either pay taxes on the $100,000 that you didn't cover, or you get a loan for the $100,000 at the time of acquisition. Seller carryback works, assuming the seller's loan works. Actually taking it subject to does, as long as you have a paper trail to show that you serviced the loans with the income that was generated by the property, or any combination of the above works as debt replacement as far as the feds are concerned. Earnest money we will forward to the acquisition as long as we're holding the funds at that point. If we're not holding the funds at that point, the client then would just wire a check or money to escrow for the acquisition. And then once we put the money into the acquisition, when they go to close, we'll instruct escrow to reimburse them the original earnest money deposit for that property that they're buying. This is really important. How safe is my money with the accommodator? Well, every accommodator is different. And there's some very good accommodators out there. We're not the only great company out there. I think we might be, but really, there are other good ones. And there's some very bad ones. And I really caution you to look at, these are the requirements that you have to hold the accommodator's feet in the fire to. Number one, never work with a company that only commingles funds. They put into a single trust account because they get a higher interest rate off the float. That's the bottom line. It's okay for the accommodator to make money off the float, but it's not okay to put it in a single account. And a lot of accommodator does it. It should never be commingled because those are the easiest files to get fraud on. You see more theft from people in our country who are trying to hack via their computer, or from people out of the country, whether it be in Europe, or Russia, China, wherever they happen to be. And they try to hack exchange companies, title companies, and escrow companies. And this is a regular routine on their part. Never work with a single account. It should always be never commingled, but set up as single client trust accounts. So the money's in trust by the accommodator for the client. Number two, it should never sit in a corporate account, only into that trust account. Why? Because if something happens to that accommodator or they go bankrupt because they over leverage themselves, you know what happens? That client's money goes into the bankruptcy court, and the bankruptcy court will pay off what that accommodator owes. You lose your exchange, folks. It's ugly, and it happens, even with title company exchange companies. So be careful. Number 3, the client should sign an authorization to release form. Companies like ours will include that on the up-leg documents. And we would have already had copies of their signatures before. Yes, we use DocuSign, but we also submit a form to them so we can compare signatures when they want to execute an authorization to release fund, whether it is for the purpose of EMD going into the acquisition, or if it's for moving all the proceeds to close the purchase. And what we do is we, even on top of that, we get their cell number and we call them just to verify. Did you just send us, say, authorization for release form? Do you know how much that was and where it goes? We just want to make sure that who's asking for this is really that person. And good companies do that, but many of them do not. Bonding is very important, but it's not going to do you any good if you don't have 1, 2, and 3 in place, because you'll get it back with the bonding. But the problem is it's too late and you lost your exchange. You have to go back and pay all the capital gains taxes. And make sure they have internal legal counsel. I'm not talking about just general lawyers or title lawyers or escrow lawyers. I'm talking about exchange lawyers, a full legal department. Remember, it's got to be a call. Go ahead.
I have a couple questions as you go to the next slide.
Mm-hmm.
When the agent says, I have a client who wants to sell his owner-occupied duplex, then lease back 1 unit. Any legal way to protect the capital gain incurred?
Yes. On the principal residence portion of the duplex, they would get the 121 principal residence exclusion. If the exclusion covers the whole gain just for that unit that they live in, then that's great. If it doesn't, then they pay taxes on the difference. On the investment portion, we set up a 1031 tax deferred exchange, and they can acquire through that other investment real estate of equal or greater value, like we just talked about.
Okay, thank you. And then how does it work when you are receiving commission on the buyer side of the transaction from a 1031 as a credit for the transaction as a credit for the sale? Do our commissions affect the buy side net, and should it be factored in? Or
no, it's normal.
Buy down acting as cash from a personal account.
Yeah, anytime let's say you're the listing agent for your own property, no problem. You can pay yourself a fair market commission. What's that these days? Between 5 and 6%, I guess. But the bottom line is, I guess some people are doing it for 4%, but the bottom line is you can pay yourself fair market. But if you're going to give yourself 10%, that's not fair market anymore. Same is true if you're getting commissioned on the acquisition. You can do that. It's fair, as long as it's fair market, it's allowable. And on the sale end, it's the non-recurring cost to sell, even though you're getting the commission on it. Personally, would I do it if I was an agent? The answer is no, because I don't want to tax defer that money. Why would I want to pay myself a commission and then give 30, 40% of it to the government? So I wouldn't want to do that, but some agents would, and that's fine. It just depends on what you want to do and how you want to do it. So was there another question go with that?
Thank you.
You're welcome. All right. We don't have a lot more time to talk about the qualified exchanges, LLCs, corporations, trusts, limited partnership. But I do want to talk about this real quick. I get this question quite a bit. I speak at about 150, 160. I think it's actually more now with Zoom and all this COVID thing. Seminars a year to boards and CPA associations, bar, escrow associations, blah, blah, blah. Here it is. This is the #1 question. Can I move into the property? Don't ask me that question. I'm not a CPA. That's a later on down the road tax question. You know what that means? You better not be answering it either, or I hope your E&O is all paid for, because you're going to need to use it. Folks, you can't tell the person it's okay to move into it later on. Is there provision to move into it? Well, there is, if there is a, look at the bottom, the purple, unexpected, unforeseen, unplanned change in somebody's situation. What if you can't rent the property anymore? What happens if you you have a financial downturn personally. What happens if there's a marriage change, like a divorce, a death? What happens if there's a health change? Things could happen that are unanticipated down the road. There's provision for that in the code after 2 years. But to buy the property with the intent to convert it into a principal residence, government doesn't buy that. And if they find out, they'll go back and tax you. Now, people say to me, I know so many people who have done that. Well, I have something to say to them. Have you ever driven 85 miles an hour on the freeway? 75 miles an hour on the freeway? Yeah. Did you get caught? No. Well, because there wasn't a CHP there, or there wasn't a police officer with the radar on. You got away with it. And that's what happens with some people. But if you get caught, you're going to go back and pay the taxes and the interest on the taxes that you would have owed when you sold. So the bottom line is, don't give out this information. It's bad information to give out. There is provision, but only in unforeseen, unplanned situations. Some people are smart enough to go out and put it on Facebook that they're going to move in. It's like, why would you do something like that? Anyway, okay. There's a lot more we can talk about. And if you'd like me to come back, I'd be very honored to do so or whatever. But let me just really quickly. I have a number of marketing pieces, approximately 17 of them. One is actually in Spanish. The rest of them are in English. They talk about questions about cash flow, rate of return. What is your current property giving you back based on the equity, the income, minus the expenses? In fact, it's called ROI versus ROE. And here's a worksheet, how to calculate that. And that's one of the 17 or 18 pieces that I have. I have letters for out-of-state owners who need, maybe it's time for them to sell their property and do an exchange and buy something closer to where they live so they can keep an eye on it or manage it. There's other people who want to re-leverage because of increasing the rate of return or their appreciation. And of course, that involves re-leveraging. What about if I want to go into other types of properties that I don't want to manage anymore because I'm getting old and I can't do that? I'm in my 70s or 80s or whatever, and I want to go into a triple net lease property where Trader Joe's, CVS, Walgreens, 99-cent only store, and all these fast food places that are going crazy, where the corporation can be my tenant and they pay for the property taxes. They pay for the insurance on the building. They pay for the maintenance and upkeep on the building. I don't. I have a corporate tenant. I get paid every month. I don't care. I want out of that business, but I don't want to get off the income wagon, and I don't want to pay capital gains taxes. I could even go into a DST, which is called a Delaware Statutory Trust, which allows me to acquire non-REIT properties. It's not a REIT because REITs are not allowable. It's not like kind because you own stock, you don't own property. But they'll let me go into these types of properties as replacements so the properties will provide income for me. So I can prepare myself and kind of have an exit strategy along with hopefully a stepped up basis to my heirs. I've got marketing pieces that deal with a lot of these things, and I'll give them to you. There's no cost, except there are two requirements. Requirement number one, you see my email address on there? Send me an email. I will gladly give them to you. Here's the second requirement. It's a little tougher. And please don't get mad at me. You got to use them, folks. These marketing letters will do you no good if you don't get a farm package, or if you don't and start creating new relationships with people you don't know, or start working with the ones who already own multiple properties in your farm that you've had a relationship, to try to get them to encourage to rethink their property, to see if they've maybe outgrown it and it's time to re-leverage a little bit. 75% of what we do is marketing. It's getting in front of other people. And that's the name of the game. You don't have to sell. You just have to educate and create a relationship. That will happen. Listings will come. Well, that's pretty much it. I know my time's up. I may have exceeded it a little bit, and I apologize for going over. But I would be very honored to come back if you want it, and we can talk more about some of these advanced questions and other issues of qualified versus non-qualified, and how the IRS respond in this situation and that situation. And it's a pleasure to do so, but I'm so honored to have this relationship with so many of the Coldwell Banker offices. And I thank you for the opportunity to serve you and to answer your questions regarding an exchange. Whether it's my deal or not, it's my pleasure. And I hope this was valuable. Are there any last questions I can answer before we end this Zoom session today?
I have to tell you, that was a lot of information, great information. So gracious with your time. Truly appreciate that. I don't have any other questions, but a lot of comments, just that it was good information. We would love to learn more. So for sure, we will have you back, Phil.
Thanks, Vicki.
And for all those that, you know, again, there's Phil's contact information. A lot of you had a few questions and said you were going to reach out. So there it is. And then we'll reach out for another time to get together and talk about some of those more advanced areas.
My pleasure anytime. Until then, you get stuck, you need some help. I'll be happy to speak to your client and answer all their questions and direct them right back to you. It's a pleasure to do so, but you don't have to feel like you have to answer those questions. You gotta have to have people around you who can help you do that. So thank you.
And if anybody has any other questions, you can contact Phil direct.
Absolutely. Have a great day, everybody.
Thank you, Phil, so much.
Thanks for having me.
Take care, everyone.
Thanks, Vicki. Bye-bye.